Happy Monday out there, Team 42. It's your skipper here, Darius to present our macro minute for Monday, August 5th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to stay on the right side of market risk, you need to be a client of 42 Macro. So today's key macro questions are, will the Fed be forced into an emergency rate cut? And will an emergency rate cut save the crypto market from mispriced fairy tales about liquidity? Our answers are, we were correct in explicitly calling for the Fed to begin cutting the policy rate in July, as evidenced by the crisis of confidence being signaled by global financial markets. We do not believe the Fed will opt for an intermediate cut based on current conditions. We do believe they will if the repo and/or credit market seize up in the coming weeks. Those dynamics are impossible to predict, so it will be important for investors to continue relying on the risk management overlays featured in KISS or in the proper trade recommendations prescribed by our discretionary risk management overlay, aka Dr. Mo, to successfully navigate this cross-asset correction. Recall that both systems began raising 42 Macro client allocations to bonds in early June and reducing 42 Macro client allocations to stocks, commodities, and crypto in late June, while continuing to take down risk throughout July and before the so-called yen carry trade began unwinding last week. Trust the process, and the process of signaling capitulation is yet to be observed. One thing I'll finally say is just kind of hitting on some of those movements that we've made over the past few weeks. We're proud here. We're proud folks. We work very hard to deliver fantastic results to our clients on a daily, weekly, and monthly basis. And by and large, our signals have been working. I say this all the time. Our signals aren't perfect. We definitely have forecast error. We definitely have signal error. But by and large, if you think about how we've risk managed clients in terms of helping them make tons of money, going back to the bull market we appropriately positioned for back in early November, all the way to starting to take down risk starting in late June, that's about as good as you're ever going to get in terms of staying on the right side of market risk. So let's just run down some of the changes that we've seen in KISS and Dr. Mo that 42 Macro clients have benefited from in recent weeks. So on Friday, we sold our entire Bitcoin position in KISS. And obviously Bitcoin's down, 10, I want to say somewhere between 10 and 13% today. It's down 18% since we sold it on Friday. Just be aware of that. Ethereum's down, somewhere around 15 to 18% today, and it's down 31% since our Dr. Mo pivoted clients to no position in Ethereum from a long half position on July 27th. If you look at the stock market, the SPY and Qs were cut from long half position to long max, they were cut to long half position from long max position on June 25th. Energy materials, high beta were each cut to short half position from long max position on June 25th. Global equities and emerging market equities were cut to short half position from long half position on June 25th. Japanese stocks were cut to short max position from long half position on June 25th. The SPY was cut to short half position from long half position on July 19th. Commodity producers and Eurozone stocks were cut to short half position from long half position on June and late June as well. Treasury bonds are upgraded to long max position from long half position on June 16th. The 10-year yield was 50 basis points higher than leverage loans, which everyone was crowded long due to the elevated interest rates. That was cut to short max position from short half position on June 27th. On July 27th rather. Commodities and base metals were each cut to no position from long half position on July 27th. The Japanese yen was upgraded to no position from short half position on July 27th before the big move last week. And the US dollar was cut to short half position from no position on July 27th before the big down move that we saw in the US dollar. So these are just a few highlights here. There's obviously other signals in terms of the different factors within the equity market and fixed income markets that Dr. Mo has helped clients take down exposure to on the risk asset side of things and increase exposure to on the defensive asset side of things. So as I mentioned, very proud of it. Our systems work. Our volatility adjusted momentum signal, which is the main model driving KISS and Dr. Mo, continues to be as right as rain when it comes to forecasting inflections in momentum in the stock market, in momentum in the commodity market, in momentum in the fixed income market. It's forecasting inflections in momentum in the crypto market and in momentum in the currency market. And we are not going to apologize and mince words for helping our clients stay on the right side of market risk, because that's what they pay us to do. So wrapping up with a question, as always, from our 42 Macro community here. This one's regarding gold. This is gold's at the beginning of transition. So it reads, "Hi, Darius. Based on your extensive experience, I'd like to hear your thoughts on this. I expect the gold prices to rise strongly due to geopolitical pressures and inflation fears, but it has remained within a range. I've read some articles suggesting that there's heavy selling in risk assets. Gold can be negatively affected despite being considered a safe haven. Would you please share your perspective on this? Thanks for your valuable time. So yes, this great question about the client. That's exactly what we have observed as well, is that in times of actual severe market stress, thinking about 2008, 2011, 2020, we have seen investors reach for things like gold and other assets that have historically done well in deflationary types of environments, and use that as a source of funds to take down overall portfolio risk. We actually saw that in the financial crisis, where you saw investment grade credit spreads actually gap wider than high yield credit spreads because investors were unable to sell their high yield bonds. And so they, in order to take down broader portfolio risk and raise cash, they were selling what they could sell as opposed to what they should have sold. And so we see, we've seen this in gold specifically, as most recently as March of 2020. We saw it in the treasury bond market as well in March of 2020, when investors were liquidating treasuries because they couldn't get out of their equity and crypto exposures and credit exposures fast enough. So just be aware of that. As you certainly can see these things occur, it's hard to predict, it's hard to forecast these types of market developments. But what we do know is that whenever the positioning cycle gets very one-sided, like we've been warning about with respect to the medium to long-term positioning indicators featured in our positioning model, signaling elevated risk of a crash in risk assets for the past couple of months, we have been flagging that for clients. When the positioning cycle gets as one-sided as it becomes, then you start to see these kinds of squirrely, aggressive, high-speed market unwinds and kind of cross-asset repricing dynamics take place, i.e. gold being used as a source of funds for people who can't get out of equity and credit positions. So again, it's hard to predict these types of systems, but this is why we rely on our quantitative risk management systems when it comes to building or taking down positions in our portfolio, as opposed to what the client is talking about, which is I thought this, therefore I thought this, therefore. That's not the right way to manage risk. If you people learn anything from me before I get hit by a bus, is you do not manage risk on the basis of your predictions. You manage risk on the basis of your quantitative risk management signals. If they tell you to take up exposure to an asset class, you take up exposure and ignore what you thought. If they tell you to take down exposure to an asset class, you take down exposure and ignore what you previously thought. What you think about the future should inform you on what types of securities you want to buy and sell, but they should not be informing your decision to buy and sell those securities. Leave that stuff to the quantitative risk management signals. And if you don't have, very good quantitative risk management signals to rely on, we obviously make those available to investors all around the world at a very affordable price point. And that is my promise to you guys until I'm retired. So we'll wrap it up there. Darius Dale presenting our macro minute for Monday, August 5th, 2024. Best of luck out there. Some folks need a little bit more luck than others, especially if they have not taken down risk appropriately alongside 42 macro clients over the past 6 weeks, and or they have not taken up their exposure to the bond market like we have over the past 6 weeks as well. So just be aware of that. If you need more luck, you don't need to rely on luck. You can just come hang out with us. We'll definitely do a much better job of helping you manage portfolio risk than I think a lot of folks have been used to out there. So thank you. Appreciate you guys. Catch you back here tomorrow.